I'm delighted to introduce for our first speaker in this room this afternoon, Richard Shepherd-Cross. Richard joined Matoli Woods in 2009 to establish Custodian Capital as the property fund management subsidiary, and in 2014 was instrumental in the establishment of the Custodian Property Income REIT. Following the successful initial public offering, which I think was about 150 million, Richard's overseen the growth of the company to its current market capitalisation, with net assets now of just over 600 million and a yield of just north of 7%, achieved through a combination of both acquisition, capital raising and performance. So who better to talk to us about the property sector? Richard, over to you.
Thank you very much. Now, I haven't looked at the card to see who you could have been listening to in some of the other rooms, but thank you for joining me, and hopefully with, well, I've overshot. We'll go straight in, never mind. We're going to talk about commercial property, and particularly about Custodian Property Income REIT, which has the ambition to become the REIT of choice for private and institutional investors seeking long-term secure income from a well-diversified UK property portfolio. And really, I'm going to be talking about three things today. So if you remember nothing else, the three things I'm going to talk to you are income, timing, and risk. So we're going to keep it simple. But let's just look back at the year, the 2 years that we've had, two really difficult years for commercial property. We've had inflation, the rising interest rate, that really hurt commercial property, and we saw values fall by as much as 25% or more from a high point in 2022. And there's been very limited transactional activity since then, with weak sentiment to the sector. But I forecast at the start of the year that this would be the year of recovery. I've still got 2 months to be right. But we are seeing those green shoots. We've seen stable capital values through the year, and if we look at our portfolio, valuations have been pretty flat now for 9 months. We've seen discounts narrowing, so the discount to net asset value has narrowed. And again, since June, our share price has moved on between 15 and 20%, depending on which day you look. But perhaps more telling is that private equity is stalking the UK commercial property market, and very particularly in the listed sector. There have been a number of take-privates, but names like Brookfield, Lone Star, Starwood, all very active in the sector. And US private equity doesn't normally get out of bed unless there's a very reasonable opportunity just around the corner. So I think this is the year of recovery. Inflation has stabilized. The next move for interest rates, we hope, is down. I know everyone is panicked about the budget, but let's hope that passes without too much disquiet. But fundamentally, for real estate, while all this noise has been going on, and while the investment market has been weak, the occupational market has been strong, and it's been delivering rental growth. So let's consider that market. Firstly, to say that in the listed sector for real estate, there's been significant change. A number of names no longer around following consolidation of UK commercial property REIT, is now part of Tritax Big Box, LXI and Secure Income REIT, part of London Metric, as is Columbia Threadneedle Property Trust, taken private, Eddiston, Aberdeen Property Investment Trust after 20 years as a listed trust, and the Balanced Commercial Property Trust under offer to US private equity at the moment. And then we see a bit of a tussle going on for Tritax Eurobox. Segro had made an offer, and Brookfield have recently trumped that offer. So that leaves a much shrunken sector for investors. And looking particularly at my part of the market, the diversified, very income-focused funds, just four: Picton, ourselves, Schroeder, and AEW. And I hope after the next 15 minutes, you'll consider there's only one. But the conditions, I think, are very well set for a recovery. Two charts here. The one on the left is looking at rental growth and the three key commercial property sectors. The black line, industrial and logistics, very strong rental growth for a considerable period of time now. And while the rate of growth has slowed, still positive rental growth. Retail, which is the orange line, after 6 years of lackluster or even backwards rental performance, we are back into rental growth for real estate. And perhaps the surprise line here is that there is rental growth in the office sector too. Now, that is not to say that all offices are going to see rental growth. It's a very nuanced market, but for the right assets, positioned correctly for occupiers and importantly, as always the case for real estate, in the right locations, very strong rental growth. And we'll look at some of that as we go through. So rental growth, always good for real estate. And on the other chart, I'm going to look at just two lines. The yellow line, which is the IPD equivalent yield. The equivalent yield, very much property terminology, I'm sure you all know, but just in case you don't, it's the weighted average yield between the initial and the reversionary yield. So it's a yield that takes account of future rental growth. And you can see how those yields have moved out since 2022. And the forecast, and this is a Collier's forecast, is that those yields are going to start to come in. So that suggests positive capital value growth. And importantly, the blue line, the forecast cost of funds, is falling. So opening up that wide margin above the risk-free rate. Again, strongly positive for real estate. So what's this impact been on Custodian? That continued strong leasing performance has enabled us to increase our dividend by 9% from last year to the year in prospect. Based on the average share price over the last month, that gives an entry yield of about 7.25%. That feels pretty decent to me. That resilient occupier market that I've talked about has meant that the vacancy rate has fallen. But I'm an optimist, not a pessimist, so I call it the occupancy level. And the occupancy level has gone from a year ago around 90% to 92%, and following lettings that we've completed just this week, that occupancy has increased to 94%. So really very positive, because that high occupancy level, again, drives rental growth. Like for like, for the year to March, so this is, I accept these numbers are getting a little out of date now, but these are our last reported numbers. We saw rental growth of 5.6% across the portfolio. And recent examples of rent reviews, with rents settling 29% ahead of the previous rent, but importantly, 7% ahead of our valuer's best estimate of the rental value. Now, why is that? Not because the valuer's got it wrong, but because when rents are growing, the valuer isn't necessarily looking backwards to evidence of rents that have been agreed in the market, but occupiers are looking forwards to their next 5 years of occupation. So strong rental growth, and we were able to make accretive disposals. Why is that important? Because in any commercial property portfolio, there is a capital expenditure budget. It's what my FD likes to call discretionary capital expenditure, and I point out it's not discretionary. This is money we have to spend in order to keep these properties up to date. But very happily, where we've spent that money, and again, we'll look at some examples as we go through, we've seen higher rents, higher values, and every pound that we've spent has been returned to us. Again, on the subject of rental growth, I'm just going to draw your attention to one chart here in the bottom left-hand corner. This looks at the reversionary potential, so the valuer's estimate of the rental value of the portfolio against the passing rent, the rents we're collecting today. And it goes back over 10 years. And you can see how that rental growth, that rental reversionary potential has built to the highest it's been for 10 years, some 15% ahead of the current rental income. So when we're considering timing, when do you want to get in? When rents are ahead of market value, or when rents are behind market value and there's the opportunity for that growth? I'm not going to answer that question for you. This is a real estate fund, so I think it's really important to look at some real estate. And I think this puts into context some of the numbers, some of the charts. These are all assets in our portfolio. This is from the industrial and logistics sector that make up nearly half of our portfolio, where there remains very strong occupier demand. There is limited supply because there's been very little development, particularly of the sort of assets that we like to buy, which are slightly smaller than institutions would typically buy, so around £5 to £10 million assets. And as a result of build cost inflation, that's putting pressure on rents to grow. And you can see here, both in new lettings and rent reviews in the last year, rents growing anywhere from 12 to 64%. It's really meaningful rental growth. And of course, it's that rental growth that supports earnings, and the earnings that cover the dividends, and it's the income from those dividends that drive the majority of total return. So you can see why I keep coming back to income. And here's a case study. This is a building we own up in Winsford in Cheshire. We have just refurbished it following the end of a lease to H&M, the retailer. We have fully decarbonised the building, so it has now got air source heat pumps. It's got solar panels on the roof. Why, you might ask, do we not have more solar panels on the roof? And the answer is that those are sufficient solar panels to meet the requirements of the tenant in occupation, because you don't get a very good return on selling solar electricity back to the grid. So you're best to use it on site. We've got air source heat pumps to heat the offices, and we spent £2.7 million on that building. But in doing that, we improved the environmental performance certificate, the EPC, from a C to an A, and we let that building on a new 10-year lease at a rent that was 18% ahead of the previous rent, and that's added 20% to the value. So all that money that has been invested has set that property on course for the next 10 years. And of course, it meets our legislative and moral obligation to the environment. But it's not just about industrial and logistics. Ours is a diversified portfolio. And you might be surprised to see, as I mentioned earlier, that there is rental growth opportunity in the office sector. So 2 buildings, one in Oxford, where we have just renewed a lease at 58% ahead of the rent that was set 5 years previously, and in Leeds, 45% ahead, following a refurbishment. In Oxford, there was no refurbishment, that was just a straight renewal. And in other sectors, tenants committing to long leases. 2 of our units we've let to 10-pin bowling have both taken 25-year leases. That shows a real confidence and commitment to the market. And I think the sector to watch is retail warehousing, out-of-town retail parks. And just one example of one of our properties in Leighton Buzzard, where we've just seen a 15% increase in the rent following a new letting. And there was an interesting piece in the property press just a week or so ago talking about the demise of Carpetright, which is going to release 200 stores, vacant stores, into the market. And on first impressions, you'd think, well, that is going to suppress rents because we've increased supply. But actually, the argument was made, and I think it was a very valid argument, actually, this is the opportunity for rental growth. Because that retail warehouse sector was almost 100% occupied across all markets, not just on our own portfolio, there's very little opportunity for the landlord to get amongst it and push those rents forward. But those 200 former Carpetright stores are going to enable the landlords in all of those retail parks to set a new benchmark rent. And I think we will see more of that coming through in the retail warehouse sector, which for us is the second largest sector in our portfolio. And even on the high street, both in Shrewsbury and Edinburgh, strong rental performance. And this is the example of the buildings in central Leeds that we've just refurbished that I referenced on the previous slide. Again, improving the environmental performance certificate, driving on the rents, 45% increase. Also seen a commensurate increase in the valuation. So there is life in all parts of the country and in all sectors of the market. So I hope that's made the case of timing being now. Now is the time to get into the market. Valuations haven't really reacted yet to the first cut in interest rates. So there is still time. The listed sector has reacted. We've seen the discounts narrow, but I think there's still a way to come. So the next thing I'm going to talk about is income, and this is the important bit. This is the DNA of Custodian Property Income REIT. We try and find those higher risk-adjusted yields from a diversified regional commercial portfolio, trying to provide access to that in an institutional grade package, because we've got 150 properties and over 300 tenancies. Our average lot size is 3.8 million. And that is below the dignity of many of our peers in the market who really are considering properties of 10 to 15 million pounds plus. But we think there's a real opportunity to drive those stronger income returns, and I'll explain how we do that with this chart. So this is the one to remember. If you remember nothing else apart from timing, income, and risk, remember this chart. What it looks at is the net initial yield of properties sold in the market going back to 2000. It tries to capture whole market data. What it looks at is, in the dark blue line, properties that have traded with a lot size of less than 10 million, and the light blue line, properties that have traded with a lot size of more than 10 million. And you can see that from 2000 to 2010, there was a very consistent, quite narrow margin of about 65 basis points. So we could call that the risk premium. That's the risk premium for taking on those smaller properties where you might have smaller tenants, but certainly not always the case. But I would argue that it's not all risk. Some of it is just, I can't be bothered to manage a large portfolio of small properties when I could have a more concentrated portfolio of larger assets. So let's call the risk premium 50 basis points. It also makes the math simpler. And then there's a 15 basis point hassle factor, can't be bothered. What happened in 2010 to see this huge divergence in those two lines? It wasn't a change in the risk profile of smaller properties versus larger. They didn't suddenly become higher risk. What we saw was a change in the investor behavior of the larger part of the market. Most players in the market were focused on relatively prime, relatively large assets, which in short supply meant prices went up, yields fell, and you can see how those yields fell away from 2010. And of course, it was also driven by the very low cost of debt at the time. Meanwhile, smaller properties were less in demand. Many of the same investors who were buying those larger ones were selling their smaller properties, increasing the supply. So what you're seeing is not a change in the risk profile, but a change in the supply and demand dynamics in the market, such that since 2010, there's been a 150 basis point margin. Yet I hope I made the case that the risk premium is only 50 basis points. So I think, we believe, that we get 100 basis points of margin for taking no additional risk. And it's that higher income return that supports our earnings, that support the relatively higher dividend, and that ultimately lead to outperformance. This is a simple chart that just looks at the light blue line, our earnings per share, versus the dark blue line, our dividends per share. So you can see we've always paid our dividends out of earnings, what you would call a fully covered dividend. And we think that's so important, to live within your means and to have your dividends fully supported by earnings. And you can also see that since 2021, when the rules really changed. Yes, of course, we had COVID, but and as we came out of that, we've started to see increasing interest rates, fundamentally changing the dynamics of the market. But we've been able to grow those dividends by, on average, 5% per annum since 2021. And we don't benchmark Custodian. I think the trouble with benchmarking is that you end up with an equal share of what everyone else has got. And that rather takes away the absolute conviction of us as an investment manager and us as a company into investing what we really believe we should own. But after 10 years of trading, we did look back, and we've benchmarked Custodian Property Income REIT here against the FTSE EPRA REIT index, which is really made up of all the largest REITs from SEGRO, who make up about a quarter of the total index, and I think the smallest fund in that has a market cap of around 400 million. And when we look back, what it showed is that the share price total return over those 10 and a bit years shows Custodian Property Income REIT at positive 55%, and the benchmark at positive 29%. We've got to remember, they've been some pretty difficult years, politically and economically. But why has Custodian REIT outperformed? And would I have been bold enough to stand here 10 years ago and say that we would outperform? And I think probably, and I hope without arrogance, I would have said that we do expect to outperform. Why? Because we're all investing in the same market, and market yields through that period compressed, and we all saw values go up, and then they softened, and we saw values go down. So the underlying yields across the market remain pretty much where they were 10 years ago. So no one in the market has seen any explicit growth just through yield compression. Of course, that's a generalization, because within certain sectors they will have done, and in certain other sectors they wouldn't have done, but as taking the market as a whole. So if you're not getting performance through yield compression, it's got to come from rental growth and from income. And each and every year we've paid more dividend than the aggregate of our peer group. And it's that outperformance of income that has delivered the outperformance in total return. And in any medium to long-term view of commercial property investment, you would expect that 75 to 80% of total return comes from income. And that's why, at the risk of being boring, we focus so assiduously on income. Investment is about risk and return. We all know that. But after 10 years of speaking to shareholders, particularly institutional shareholders, I've come to understand that it's actually about liquidity and cost, which I think is a shame, because of course it shouldn't be about liquidity and cost. If you invest with conviction, liquidity might not be such a concern, and it should be about risk and return. And I've talked a lot about return. For us, it's all income. So let's consider risk. First thing to do is to look at our portfolio, spread very broadly across the country, as you can see in the chart there on the right, and with over 150 properties and over 300 tenancies. Split across the main commercial property sectors. And I think it's really important to include these images here, because when we talk about smaller regional properties, I think many people conjure up in their mind workshops under the arches or corner shops, but that's not what we invest in at all. And you can see here the sort of assets that we own, large commercial properties, particularly, in the industrial and logistics sector. That's 41% of the income generated from this portfolio. As I said, retail warehousing, our next largest sector, with 22% of the income, and the other numbers speak for themselves. So a well-diversified portfolio geographically, by sectors, in modern, fit-for-purpose commercial property. That's what we like to own. And we are constantly raking through the portfolio, looking for the ones that don't fit anymore. Very simple rules. There is no family silver. Every property has got to earn its keep and earn its place in the portfolio. When things aren't right, we will exit those and reinvest shareholders' funds in assets that we think will deliver the greater amount of rental growth. And that's why the portfolio is split the way it is into those sectors where we think there's the most rental growth. And when we talk about risk, diversification should be the first thing that springs to mind. And we've seen over the last few years a real focus on single sector funds. They've started to be called pure play funds, and I think that's a euphemism too far. Because let's be honest about what we're looking at. A single sector fund, a pure play fund, is a high risk fund. There's nothing wrong with a high risk fund. When they're in the right sector, high risk is also high return. And we've seen that with those funds that have been exclusively focused on industrial and logistics. But of course, it hasn't worked out so well for those that are exclusively focused on shopping centres. So single sector, high risk, but high return. So make sure you know what you're investing in, because diversification mitigates risk. And this pie chart looks at the amount of income that is paid by only one tenant in our portfolio. And you can see it's very broadly spread. And amongst our largest tenants, take Menzies Distribution, they've got 8 properties. So there's further diversification within the bars of that pie chart. So we have no one property let to any single tenant that represents more than 1.5% of the rent roll. And neither, because we are buying a broadly diversified regional portfolio, does it mean we have to compromise on the quality of the tenant or the quality of the income that is generated. And this looks at the Experian credit rating of all the tenants in our portfolio, and it shows that 81% are considered lower than average risk. So high quality, well-diversified income, all of this is mitigating risk. One of the other big risks in a real estate investment trust is balance sheet risk and gearing. And what this chart is trying to demonstrate graphically is the very wide margin that of income generated by our portfolio over the cost of debt. So in the dark blue at the bottom, that's our weighted average cost of debt. You can see how that's increased since 2022 as we've had some floating rate debt that has increased in cost. And then the light blue is the rental income from the portfolio, and the slightly darker blue above that is the reversionary potential of the portfolio. But we're maintaining that wide margin over the cost of debt, which means the custodian strategy works even in a higher interest rate environment. And if we're moving into a lower environment, then it's further going to add to that margin over the cost of debt. That's what our debt looks like. On the right, 4 tranches of debt, 3 fixed rate, and the second one, which expires in 2026, which is our revolving credit facility. So if we just look at our first refinance event, which is in August next year, that's a £20 million facility, current cost of that debt, 3.9%. And then looking on the right at the forward curve, the SONIA 3-month forward curve, you can see by the time we get to August next year, the additional cost of that debt could be very small indeed. So there's no significant refinance risk on the horizon. And as I see the clock ticking down, I can conclude by saying that this is the right time. And almost you've got a situation where heads you win and tails you still win. So if interest rates fall, that's good for income-focused assets. They will rise in value. Plus, you will have locked into the high income return you can get today. And if interest rates remain high, then total return is going to be dominated by income. So lock in to those income returns with reversionary potential that you can get today. 1 second to go.
That's excellent, Richard. It's frozen conveniently on 1 second. So we permanently have 1 second.
Fantastic.
Unfortunately, though, that means there isn't any time for any questions because we've got to get onto the panel, which is next in this room. Yeah. But I'm sure if anybody does have any particularly burning questions, Richard, you'd be more than happy to answer those sort of outside afterwards.
I will, of course.
Yeah. Thank you very much. I like the idea of heads you win, tails you also win.
Yes.
Yeah, if we just show our appreciation to Richard Shepherd. Thanks,
Thanks very much.